It's 2020. Do the fundamentals even matter anymore? Will the mathematically impossible to pay back debt ever be an issue? Can the can really be kicked down the road forever? Or have we reached a permanently high plateau? These are questions for CNBC and the growing number of gurus for them to answer. In the meantime, we can look at what happened in 2019 to make it the most ridiculous year in financial market history. You came here for the truth, so let me unveil that for you. Today we're going to talk about what has happened in 2019. There has been some extremes. We're talking about the trade issues. We're talking about the Fed repos. We're looking at all that data on a deep level. But here I just wanted to give a recap as to what has happened and give you some insight on what they haven't told you. If you look at the mainstream media, you're only going to see the charts telling you that the S&P has gone up 30%. It has been fantastic. You can't lose. 2020 is going to be even better. Everyone says so. Put all your money in, invest in index funds. You know the drill. This is what they do every single year. And of course, they don't have any idea what's happening. They just keep on raising the bar higher and higher and higher, and their predictions end up being true. And why is that the case? Well, we'll talk more about that today. I wanted to show you this because it'll lead into the rest of the video. You can see the red line, which is basically the world exchange market cap, and that has grown considerably since the beginning of the year. This is normalized as the beginning of the year, and clearly it has done very well. But the debt plus equity world market cap has grown beyond that. When you look at debt on any level, it is quite frankly just absurd. When we see this on a national level, on the corporate level, and of course individuals, they are all maxed out. They are pushing themselves to the limit. There's no way to deny that, but of course here we are today. It would have been nice to see also the GDP of the world on here and the growth and different measures that would give us a good comparison. But regardless, this is what we're looking at when you see time and time again how these markets have really responded to what has happened with the Federal Reserve, with the ECB, the BOJ, and so on. They really, really love it when the currencies are being devalued, and that really inflates these assets, whether it happens to be bonds or stocks or real estate. It depends on the cycle, but right now we can clearly see where it's going. This is interesting as well because gold doesn't really get talked about much in the mainstream media. However, normalized as of the beginning of the year, you're seeing that gold has performed quite well. I mean, it's very clear to see it on here. On this, it's showing at about 18 and the S&P 500 at about 28. So it was obviously outperformed, particularly in the last part of the year when we engaged in QE4. That really changed things. But this right here just gives you an idea of where the market has moved as a result of all the actions that have taken place. I would also like to see this chart going back into, let's say, the fourth quarter of 2018, because that is a full picture, but it doesn't matter really. That's all we're looking at. The dollar is pretty much flat the entire year. But of course, when you see the dollar, we are comparing it to other currencies. We need to see this in relation to real goods, and we cannot see the inflation, the expansion of the money supply that is within a certain indicator like the US dollar index. It just doesn't show that. Take a look at the market cap of Apple, Amazon, Microsoft, and Alphabet, just going to insane levels today. Their growth has been absurd. I mean, Apple growing $500 billion. Microsoft not far behind, and the others have performed incredibly throughout this year. The mantra is very similar to what we saw in, let's say, 99, where as long as you put your money in technology, you are going to watch your assets rise. They will appreciate because this is the new economy. This is what you got to do. It didn't work out well for so many other companies. They were gobbled up. Others went bankrupt. Assets were split apart. I'm sure you know what happened. You've probably read several books about that crash. But when you look at it today, there are quite a few parallels. However, things are different this time, as they say, but not in the way that CNBC wants you to think. We have seen an unprecedented level of intervention by the Federal Reserve. And I like this chart because it actually goes into the previous year. And you can see that there was a disconnect at some point. So they had met up at this point, comparing global stocks to the global liquidity proxy. And you could see that this just shows you that eventually they will meet again. So despite the disparities that they do have on occasion, eventually they do meet up and they do track and and trace, and they do correlate. This just gives you an idea of what has happened over the past, let's say, year and a half. Whether we are looking at the global money supply, whether we are looking at the central banks and what they are doing, ultimately the expansion of the money supply inflates assets, particularly the riskiest of assets, and we are seeing that in stocks, and of course it's going to other things like CLOs, which I'll talk about momentarily. The public doesn't understand this, investors don't understand this, they're not going to talk about it in the mainstream media, but this is the case. If you follow this chart, you will know the direction of stocks. I did a video actually just recently, maybe a couple days ago, talking about this, and if you simply want to know what's going to happen, this is what you got to watch. And there were several comments within there saying some ludicrous things about what this channel is about, and it was an embarrassment for those people. Truly an embarrassment. Unbelievable. Take a look at this here. The corporate profits have been terrible for the last few years. If you take a look at this, I'll move this over and you can see for yourself. Basically, since this point here, which is 2015, from that point on, the corporate profits have been flat. They've been flat throughout this period, and yet we've had such a growing, expansion of all of these corporations and their value, their market cap, and yet their profits have been flatlining. We did see the same thing happening in the 90s, as you can see the green line, which is the S&P 500, and then we know what happened after that. We're watching that pattern repeat here. Who knows, of course, where that will go. It could be many, many years before that changes. Only time will tell. This is the earnings where you look at how dismal they have been over the year. This continues to get worse. Normalized as of the beginning of the year, clearly the earnings and the actual price of the stocks have been disconnected, and there's no telling if this is ever going to come back together. Congratulations to Canada. Apparently, the loonie tops the leaderboard of major currencies in 2019. I'm actually surprised about this, considering no major changes had occurred. You can look at the chart here if you're interested in knowing what currency, maybe the country that you're from, or you're just interested in seeing the movement. The foreign exchange market is quite an important thing to be watching on a relatively regular basis, just to see how certain political problems that a country might have, tensions and easing and so on, all really factor in to what's happening to that currency, how that affects the people in their own home country. There's so many things to be paying attention to. This surprised me. Conference Board consumer confidence year over year down at the end of the year. Now, I'm not sure if this is going to show up in all of the data for year end, because usually you do see a strong year end because people are buying, people are consuming, and yet right here you're seeing it just barely though in the negative. Previous to that, you do see 3 months in a row in the negative, but it was interesting to see how this continued on. I want to see in the next quarter what comes of all of these numbers. Is it just a short period of time in which things change, or is that more of a long-term trend? Now we get into the real deal. So if you stayed through the video at this point here, usually only about 30% of the people make it to this point. And if you do, you get the real deal. Some 40% of stocks quoted in the US have a negative tangible book value, meaning their tangible assets aren't worth enough to repay all of their debt. That's an important stat. Now I know there's countless people who believe that that's not important anymore. We don't worry about that. The fundamentals don't matter. The statistics don't matter. All that matters is that Uber is fantastic. Everybody takes an Uber. Therefore, it is great. And that isn't the way things work. Now, that company might be doing well. You might want to invest in that company, but there are certain things you can't get around. I don't know all the internal workings of Uber. I don't know what's going on internally. I don't have any insight on the company's accounting. You got to do whatever you want. But I'm simply showing here some basic rules that need to be followed. And when those rules are broken, we tend to have these major changes that occur. The valuation of these corporations have gone just haywire. It's chaos. It's ridiculous. Take a look at this. A negative value fund composed of the shares of companies with negative tangible book value, would have beaten the main US stock market represented by the Russell 3000 index by 24% over the last 20 years. That outperformance has almost all happened since the financial crisis. Before that, the negative value fund had roughly tracked the benchmark. You gotta understand how crazy that is. I got a chart to show you that correlates to this. How to make money by companies that are worthless. Now, doesn't that sound crazy to you? If you just let me read that one more time. How to make money by companies that are worthless. It sounds like I'm telling a joke, but that's the way it is. When negative is positive, shares of companies with negative tangible book value have bested the broader Russell 3000 benchmark, particularly in the past decade. And that's what happens when you enter a quantitative easing based market. Nothing is real anymore. They don't even know what they're doing. They thought that they can reduce their balance sheet and realized they couldn't. They were going to bring interest rates up to a level that they called normalization, and they couldn't do it. So when I say that the market is broken, that's irrefutable. What's going to happen in the future? I can't tell you. My crystal ball, CNBC borrowed it. But here we are today looking at this, and it should be really making people think. This article here is talking about the CLOs, the collateralized loan obligations. And if you remember what happened throughout 2008, we had the CDO, and this was so fantastic. I mean, the collateralized debt obligations were something to behold. They still exist today, of course, not to a degree that we had back in 2008, but certainly they are still there. But largely, we are finding that, in my opinion, is actually worse. We have these CLOs, and these are apparently here to stay. It's a cross between two of Wall Street's hottest markets: commercial mortgage bonds, which are backed by mortgage payments on apartment buildings, malls, and the like, and collateralized loan obligations, which are pools of bonds backed by payments on corporate borrowings. Right now, banks sold $21 billion of this stuff. Back in 2012, less than $1 billion. So we see that this is a growing market. Issuance is soaring because investors are thirsty for financing to fix up buildings. They take a risk. Who knows if it's going to turn out? And that's where, of course, they get that return. Investors ultimately take a gamble on these. They talk about the rating agencies in here, and we know about the rating agencies and the criminal activity that they were engaged in a decade ago. All of that has been forgotten. All of them are rated AAA. We know the way it works. But of course, they'll point to all the other ones that are so safe, so sound for this reason or that reason, and they simply ignore reality. We were lied to 10 years ago. We were lied to through the 90s and through the 80s. There's enough examples just in the past few decades to give us more than what we need to know these people are liars. They don't care about you. They don't care about what you do with your investments, your 401k, or anything else. They sell us junk. They sell us garbage. They wrap it up with a pretty little bow on top. And our banks make gambles on this type of garbage, and everything is at risk as a result. I'm going to end the video there. If you found it informative, hit that thumbs up button when you do. You're supporting this channel, so I do appreciate that very much. If you want to learn how to build a business, if you want to learn about passive income, you can definitely check out my free course at theamazongps.com. If you want to learn about the foundation, the history, the asset classes, how to make money, and reduce your debt, I've got all of that, what you need to know in these two books. Check it out at the link in the description. If you want the audiobook, that's available at themoneygps.com. I wanted to take this time to say Happy New Year to everybody watching. There's about 10 to 15% of the viewers stay in this point, and I want to thank each and every one of you for sticking with me to the end, for sticking with me all through 2019. 2020 is definitely going to be an interesting year. Hope you will all be with me. If you have any requests, if you have any suggestions, you can always let me know in the comments. I check the comments multiple times a day, 7 days a week, 365 days a year. The channel's growth has slowed to a halt. It doesn't matter to me. I want to make videos that people are interested in, and I want to share the truth. Thank you all. Take care.